$2 million invested, drawn at the rate Morningstar published for 2026, and taxed the way a real retired couple actually gets taxed, deposits about $5,470 into a checking account every month. $5 million, same rate, same tax treatment, deposits about $12,900 a month. That is the whole comparison, and I want it sitting in front of you before anything else does. 2.5 times the balance, about 2.36 times the check. And then the part that made me go back and rerun the arithmetic 3 times, the data on what households at those two wealth levels actually spend puts their ordinary Tuesday within a few $100s of each other. Not their net worth, not their statement, their spent month. The groceries, the gas, the restaurant bill, the flight, the thing you actually experience between waking up and going to bed. So the deposit gap is real, and it is large, and the lived gap is small. Both of those are true at the same time, and the distance between them is the entire subject here. Somewhere between those two columns, there is a wealth level where another $1 million stops raising your standard of living and starts doing a different job entirely. You may already be closer to it than you think, because nobody sends a notification when you cross it. Let me size the gap honestly before I start shrinking it, because if I understate it now, you should stop trusting me. Morningstar's 2025 State of Retirement Income Research puts the base case starting withdrawal at 3.9% for a portfolio holding between 30 and 50% equities, funding 30 years of inflation-adjusted spending with a 90% probability of money still being there at the end. That is up from 3.7% in the 2024 edition, which is what improved market assumptions do to the number. Retirees willing to flex spending with market conditions can support as much as 5.7%, and we will come back to that because it turns out to be one of the few levers that beats saving another $1 million. 3.9% on $2 million is $78,000 a year. On $5 million, it is $195,000. So the paper gap between these two households is $117,000 a year. That is not a rounding difference. That is a second household income. But look at the smaller column for a second, because it did something I did not expect. The Bureau of Labor Statistics measured average annual expenditures across all American consumer units at $78,535 for 2024. The $2 million portfolio by itself, before a single Social Security dollar arrives, produces $78,000. Those two numbers are $535 apart. The portfolio alone, at a conservative rate, funds the average American year. Now watch what happens to that $117,000 gap, because it does not survive contact with the tax code intact. Assume both couples are 65 or older, married filing jointly, pulling everything from traditional accounts, so every dollar of it is ordinary income. I am stating that assumption out loud because it is doing real work in everything that follows. Run the smaller column through it. On $78,000 of withdrawals, after the deductions a retired couple at that level gets, the federal bill lands around $3,560. That is an effective federal rate of 4.6%. The progressive structure barely notices this household. Run the larger column through the same machinery. On $195,000, those same deductions cover a far smaller share of the income, and the top slice of the withdrawal is taxed at a rate the smaller couple never touches. Federal bill, about $25,240. Effective rate, 12.9%. So the progressive structure takes $21,680 more from the bigger column than the smaller one. The gap falls from $117,000 to about $95,000 a year, nearly 3 times the effective tax rate on 2.5 times the income. Before I keep going, one quick thing. I wrote a digital book called The Exit Code. And the reason it exists is that the chain we are walking down right now, balance to withdrawal, to tax, to deposit, to what you actually spend, is 4 steps longer than any retirement calculator will show you. The link is in the description if you want the whole framework. Back to the arithmetic. State tax is the next bite, and it is the boring one. Take a middling 5% flat state, which is roughly where a lot of the country sits. That is $3,900 from the smaller household and $9,750 from the larger one, gap down to about $89,000 a year. Then there's the floor cost that scales with your income rather than your consumption, which is the one people at this wealth level actually get ambushed by. The standard Medicare Part B premium in 2026 is $202.90 a month per person, up 9.7% from last year. For a couple, that is about $4,870 a year, and both households pay it identically, except the premium stops being standard above a line. For a joint return, the income-related surcharge starts above $218,000, and it is a cliff, not a slope, $1 over, and you pay the whole next tier for the entire year. The latter runs up to $689.90 a month per person, with a prescription drug surcharge stacked on top, running from $14.50 to $91 a month. The 5 to million household pulling $195,000 sits $23,000 under that line. They clear it, for now. Hold that number, because something is about to arrive that pushes them straight through it. Here is the moment where the tidy version of this video falls apart. Add it up. After federal tax, after state tax, after the health floor, the smaller household nets about $65,600 a year, and the larger one nets about $155,000, $5,470 a month against $12,928 a month. The gap started at 2.5 times. After everything the tax code does, it is 2.36 times. The progressive structure moved it by 6% of itself. So the tax explanation is dead. It is real. It is worth $27,000 a year, and it does not come close to explaining why these two households live nearly the same week. If I stopped here, I would have made a video about brackets, and you would have correctly concluded that $5 million buys a dramatically better life than $2 million. The deposit says it does. The deposit is not the month. That is the distinction the rest of this depends on, and it took me an embarrassingly long time to take seriously. I spend my working life reading the documents that most people pay someone else to skim filings, tax code, survey chart books, the appendix tables where the actual finding usually lives. I do it because 10 plus years running my own business, surrounded by accountants and fiscal lawyers, taught me that the number that matters is almost never the number on the cover. And I have multiple hundreds of thousands of dollars of my own in the market, so I am not doing this as a thought experiment. Now here comes a thing that arrives at both households in exactly the same size, and therefore does something very different to each of them. As of January 2026, after a 2.8% cost of living adjustment, the average Social Security retired worker benefit is $2,071 a month. Two claimants, $4,142 a month, $49,704 a year, identical for both couples, because Social Security is capped by your earnings record, not by your portfolio. Run it through the same machinery. 85% of that benefit becomes taxable for both households. The smaller couple's total income rises to about $127,700. They owe about $8,600 federal, and they stay comfortably under the Medicare surcharge line. Their available month goes from $5,470 to about $9,190. The larger couple's income rises to about $244,700. And there is the trapdoor. Their modified income is now roughly $237,000, which is over the $218,000 line. Their Part B premium jumps from $202.90 to $284.10 per person per month. Their extra income just bought a more expensive version of the same health coverage. Their available month is about $16,130. The gap is now $6,940 a month. The ratio has fallen from 2.36 to 1.76, and the single largest compression in this entire video came from a check that has nothing to do with either portfolio. If you want the rest of these numbers run end to end, subscribe, which puts the smaller household somewhere specific, $9,190 a month of available spending. The average American consumer unit spends $6,545 a month. The $2 million household is not scraping the average. They are clearing it by about $2,600 a month, roughly 40% of headroom. With a portfolio that has a 90% chance of outliving a 30-year retirement, the average month is already funded. So the only question left is, what happens to the other household's extra $7,000? And the honest objection is the obvious one. People with more money spend more money. That is not a theory. It is measured. In that same Bureau of Labor Statistics data, the lowest income quintile spends $35,046 a year, and the highest income quintile spends $150,342, more than 4 times. If a high-income household spends 4 times what a low-income household spends, why would a high-wealth retiree not do the same? Because retirees are not high-income workers, and the distributions do not behave alike. The top income quintile in that survey is mostly people who are still working mortgages, commuting costs, kids, career stage consumption. What you want is the behavior of people whose income comes from wealth rather than from a job. That is where this video's question changes, and it stops being an arithmetic problem. A Federal Reserve Bank of Boston study, working with panel study of income dynamics data covering 1999 through 2013, measured how consumption responds to income across wealth levels. 2 findings. The average propensity to consume the share of income that becomes spending falls from about 74 cents on the dollar at the bottom wealth quintile to about 61 cents at the top. And the one that decides this whole comparison, of each additional dollar of permanent income, only a couple of cents becomes current consumption. A couple of cents. Apply that to the 2 columns. The 5 to million household receives an extra $6,940 every single month. At the conversion rate, the data actually shows something on the order of $140 of that becomes lived consumption. Under $2,000 a year of additional spending, purchased with $3 million of additional capital. The other $6,800 a month does not disappear. It is deposited, and then it stays. That is the mechanism, not the tax code, the conversion rate. Everything up to this point was subtraction. Everything after this is behavior. And the behavior is well documented. The Employee Benefit Research Institute ran its 3rd spending and retirement study in the summer of 2024, surveying 3,661 American retirees between 62 and 75. Asked to place themselves on a scale from saver to spender, 38% put themselves in the savings mindset range. 51% were neutral. 11% described themselves as having a spending mindset. 1 in 9. These are people who are done accumulating, whose income is fixed, whose entire job now is conversion, and 1 in 9 has any appetite for it. The money can be spent. The habit of spending it does not exist. I want to be careful here, because it would be easy and wrong to call that irrational. The same survey found that 58% of those retirees left work earlier than they had planned. Of that group, 38% cited a health problem or disability, and 23% cited company changes, downsizing, closure, reorganization. 36% hit unexpected spending needs after retiring, and 59% report having 3 months of emergency savings, which is down from 69% in 2022, and which is a lot higher than the version of that statistic you usually hear quoted. So the underspending is not confusion. It is a reserve being held against a specific observed risk profile. And the bill it is being held against has a number on it. Fidelity's 2025 estimate puts lifetime health and medical costs for a 65-year-old couple at about $345,000 in after-tax dollars, roughly $172,500 a head. And that figure explicitly excludes long-term care. That is the 3rd million's actual job. It is not income. It is a lump sum with no due date, and it never shows up on a Tuesday. Which is exactly why holding it feels like nothing, and spending it feels like everything. The question of where that stops being worth it has now been answered 3 separate times by researchers who are not talking to each other. A 2018 Nature Human Behavior study using Gallup World Poll data across more than 1.7 million people found satiation at $95,000 of income for life evaluation and between 60 $75,000 for day-to-day emotional well-being. A 2024 econometric reanalysis of the well-known Kahneman-Killingsworth collaboration found that once you let the data pick the threshold instead of assuming it, emotional well-being goes flat above roughly $200,000 of household income. And a 2025 paper in Social Indicators Research using 87,335 household observations across 19 European countries found no additional life satisfaction above roughly 1 million euros of household net wealth, with Spain, Italy, and Malta satiating higher, between 2 and 3 million euros. Different continents, different decades, different measures. All of them land inside the same window. The larger household, in our comparison, is drawing $195,000 against a plateau that shows up around $200,000. They are standing on the flat part. So the full reconciliation stated precisely, because I do not want you to leave with a slogan. The balance ratio is 2.5 to 1. The gross withdrawal ratio is 2.5 to 1. The after-tax deposit ratio is 1.76 to 1. The observed spent month difference is a few $100s. What genuinely differs between these two households? The depth of the buffer against that $345,000 health bill, the ability to absorb a bad decade without changing anything, the size of what gets left behind, and the ability to be generous at scale. What does not differ? The groceries, the house, the coffee, the Wednesday afternoon. Now, you are almost certainly not either of these households. If you are watching this, you are more likely somewhere between $100,000 and $1 million, still climbing, still adding. So the question that actually matters is what shape the curve has where you are standing. It is steep, that is the good news, and it is the whole point. Going from $200,000 to $700,000 changes which of your fixed costs the portfolio can cover, which changes whether a job loss at 58 is an inconvenience or a catastrophe. Going from $700,000 to 1.2 million changes whether Social Security is your income or your bonus. Every one of those moves rewrites the month. The flattening happens later, above the level where your ordinary spending is fully covered. And the entire message of this video is that the flat part starts a great deal lower than the round numbers people chase. Knowing these numbers and building a system around them are two very different things. And the gap between them is where most of the damage happens. That is why I built a digital book called The Exit Code, 8 chapters of research, no filler, taking 50 years of retirement data and turning it into a mathematical framework for leaving the rat race on a date instead of a feeling. It goes deep on the 4% trap and the dynamic withdrawal method that replaces a rigid annual number with rules for strong and weak markets, which is the single mechanism that changes how much of your own money you are allowed to convert. It also covers the unretirement paradox, why people reach financial independence and find that leaving work did not solve the problem they thought it would, which is a very different failure than running out of money. It costs less than a dinner out through the link in the description. And the reason to look at it now rather than later is arithmetic, not marketing. The levers we are about to price all get weaker the longer you leave them alone. Because now we can price the decision you are actually going to make this year. One more year of work. Say that year adds $100,000 to your balance savings plus growth, which for most people in this window is a good year. At 3.9%, that $100,000 produces $3,900 a year of gross retirement income, $325 a month. Run it through a combined marginal federal and state rate of about 27% at these income levels, and you are left with roughly $237 a month of spendable income for life. Then apply the conversion coefficient we measured, because you will be one of those retirees. A couple of cents on the dollar means about $5 a month of that actually becomes something you experience. The rest joins the buffer. $237 a month if you spend every cent of it. Around $5 if you behave the way the data says you will behave. That is the exchange rate for 12 months of your life at this wealth level. And the currency you are paying with is scarcer than the goods you are buying. 58% of retirees did not choose their exit date. Health, disability, a reorganization, a closure. So the year you are planning to trade is not reliably yours to trade. You are proposing to sell a year you may not own at $237 a month to buy protection you already have. That is the permission number. Not a feeling, not a milestone. A measured location. Now the honest exceptions, fast, because they are real, and I am not going to pretend everyone lives at the average. If you face meaningful long-term care exposure, the third million does change things, because that is the cost the Fidelity estimate deliberately excludes. If you are retiring before 65, private health coverage is a real annual line item, and the extra capital buys the bridge. If you are supporting adult children or aging parents, your spending does not plateau because it is not your spending. If you are single, you have one Social Security check instead of two, and everything I said about compression happens later and less. If you live in a high-cost state, the floor sits higher. And if leaving a specific amount behind is an explicit goal rather than an accident, the extra million is doing exactly the job you assigned it. For everyone else, there are levers that move the lived month more than another $1 million does, and none of them require another year of work. The mix between your tax-deferred, Roth, and taxable balances is what set that 4.6% versus 12.9% difference we calculated. And it is what decides whether you trip the $218,000 surcharge line. That is a decision you make in your 50s and 60s, not at 73. Accepting spending flexibility takes your sustainable rate from 3.9% toward as much as 5.7%, which on a $1 million portfolio is $18,000 a year of additional income created by a rule rather than by savings. And Social Security timing moves a check that both of our households received identically and that neither could buy more of. None of that is a product. It is sequencing, and sequencing is free. Subscribe, and the sequencing videos come to you as I make them. Which brings me to the part I find genuinely difficult. The reflexes that got you to $700,000, defer, save, never touch it, treat every withdrawal as a small failure, are the correct reflexes for accumulating, and the wrong ones for what comes next. Your job was accumulator. Your job becomes converter. Nobody sends a memo. No advisor is incentivized to tell you the accumulation phase is over, and the cost of staying in the old role is not measured in dollars. It is measured in the specific years when you still had the knees for the trip. I do not think anyone is acting in bad faith about this, and I want to be clear about that. A 1% fee on $2 million is $20,000 a year. On $5 million, it is $50,000. The industry that helps you plan is paid on the balance, not on the Tuesday. So keep going. Build the buffer. One more year is the sincerely held, revenue-consistent advice, and both of those things can be true simultaneously. Incentives do not need a villain. They only need to point in one direction for 30 years. Lazy investing built more fortune than crypto memes. It also built a generation of people who got very, very good at the first half of the job. So here is your own number, and you can do it in your head. Take your realistic annual spending, the pre-tax figure, everything included, not the optimistic one. Subtract the Social Security you expect, which for two average earners is about $49,700 a year, and for one is about $24,800. Divide what is left by 3.9%. That is your plateau. Spend $90,000 a year. Expect $49,700 of Social Security, and the portfolio has to cover $40,300. Divided by 3.9%. That is $1,033,000. Spend $120,000 with the same benefit, and you need $1,803,000. Neither of those is round. Neither of those is 5 million. Above your own number, every additional dollar is buying buffer, which is a legitimate purchase, and which you should make deliberately rather than by default. $2 million deposits, $5,470 a month. 5 million deposits, $12,900. Both households wake up in the same bed and drink the same coffee, and only one of them spent an extra decade earning the difference. Check your number, then check the date.